Hello, welcome to Foundations of Business, Pride, Hughes, Kapur, and today we're going to do a little bit of accounting. Why it's useful, why we're doing these things, and hopefully you'll get something out of it. As always, this is no substitute for you reading your textbook or attending class. This is meant to be a supplement to your other activities. So get your textbook, do the practice examples if you have the ability to do in your publisher's handouts, and attend class. All right, with that out of the way, let's get started. Our objectives: explain why information is used to try to reduce risk and hopefully make better decisions, what you'll need in order to actually get some of the data, outline the 5 functions. Then we'll get into accounting, the financial statements, the balance statement, income, and cash flow. These are the 3 predominant financial reports that you need to understand a business if you're working there, or a business if you're looking to invest in it, or just to understand how these things work. And last but not least, just to evaluate the financial health of the company. With that being said, let's get into it. Information. Why do we even need this? Well, the more information you have, the better you can understand the true nature of a business or any activity, really. You wouldn't want to go parachuting unless you understood a little bit about the parachute itself and the risk involved in that. So obviously it's not the same when you're looking at a business, but you get the idea. You need to understand what you're getting into, and the more information you have, the more you can determine whether or not the risk involved. So, how do you get there? What information do you need for that? We'll get to that as far as the accounting tools. However, we have to start with some of the basic understandings of information rules. What is information? Well, the simplest form of information is just data, trying to understand what a business is doing. Now, when you collect all of that, that is just data. A bunch of numbers, ones and zeros, and things of that information. Once you have that, you have to process that information into something that is useful to you and others. If you're in a business, you share it with the rest of the company, and that becomes information. Most data, you have to do something with it, keep it on hand, and store it. Most people store it in some type of database, any device used to keep the information handy. Much like most of the computers you have, there's stuff stored in there, and it's stored in, if you remember anything about computers, ones and zeros, just bits. When it's pulled back up and processed, it becomes viable information like this PowerPoint. When you understand just simply going through transferring it from one form to the other, and the software and the expertise used to actually make all those ones and zeros, this lovely PowerPoint we're looking at right now. Tools that'll be used: word processor, desktop publishing, accounting, etc., etc., as you can read. If you're looking at that and know anything about computers, pretty much you're just looking at Microsoft Office. And in today's world, almost everyone should have some information or some skill set on these things. It doesn't matter where you're working, you're probably going to have to write up a report or record your activities. So the ability to do these tasks are extremely important. And if you're not comfortable with these tasks, that might be something to talk to your HR department, or if you're at a college, the library, or some other particular place to get familiar with these skills, these programs, so you're much better at these. It becomes a skill to you. What is management information? What do we mean by that? Well, these are the systems used by those higher up to get to the employees, and information that these people collect to put back into the organization so you understand what's going on. This provides everyone involved with as much information as possible to be effective on their job. And as you can see, everyone is collecting information and getting information. The 5 major groups, once again: finance, operations, marketing, HR, and admin. Just to give you an idea of what each is collecting and what they're doing with it. In finance, we're trying to understand where the financial health of the company is. For shareholders, now we're talking about stocks and how money is flowing in and out of the company. Operations used to actually the manufacturing of any goods and services. It's not so much operations if you're doing more services, but it does have that same element. You need people to actually create things if you're doing taxes, for the sake of argument. Marketing is just understanding the company, and as we talked about in other chapters, the SWOT analysis, the opportunities, the strengths, weaknesses, opportunities, and threats of a company. HR, the most valuable piece in there, all the people within the company, understanding where they're at and how we can use them to get the best out of the company, and how the company can make the employees the best they can be. Administration, the secret and mighty people who are the connective tissue between the different departments. Often underrepresented, but again, HR and administration are probably the most valuable parts of a company. They are the people. What do we have as far as our limitations? Well, our cost and limitations, how much is it going to run you for the hardware and software? Most businesses do not do it themselves. They farm out the work because it's difficult to keep up with the latest software, the latest hardware. You're better off just hiring someone to take care of that. Every time there's an update, you don't want to stop what you're doing to worry about all of that. Other limitations is if you have information, sometimes bad information gets in, and not only worried about infecting your systems, or just slowing down productivity because of unnecessary information. Junk mail to the highest degree. Now, how does everyone use these resources? Well, there's a 5-step process on that. First and foremost, you need to collect the information. You're going to run into 2 different areas on that one. I'm sorry. Usually we do get around to the pages for those who are following at home. I'm on page 441 in your textbook. Collecting the information, you can get that from your employees and your customers. Now, you may have to pay for it for information from your competitors. Obviously, they're not going to just willingly give it to you, but there are other places that are collecting data on them and you, so that's probably an alternative. Once you have it, then you need to store it. Again, most people do not store it on their particular hardware. They store it in the cloud. You can do it in the hardware as well, but you need to get all the information and obviously keep it somewhere. You want to update it. You do that through always asking and getting information about your customers within the company. What do people think's going on? And again, your competition. As we discussed earlier, you're going to process it and turn it into something useful, and then give all this information to everyone involved and whoever actually needs the information. You could worry about overload of information, and the area may not need this, but it's available to them. And we talk about processing the information and presenting it to the users, it becomes extremely important as to how that is. You're looking at three of the most commonly used ways to transfer information: a graph, a bar chart, and a pie chart. One of the things you'll probably want to do, especially people who might take a statistics class, is understand which one is better depending on what the information is. If you're looking for trends, the simple graph is probably the best as you're trying to show whether or not the company is improving, declining, or things of that nature. If you're trying to understand how it represents a percentage in the company, pie chart, as you looking at that, probably is the best tool for that. All these things represent some type of information, and you do have to actually get good at trying to figure out which one is best depending on what the information is. No one size fits all. Let's take a quick minute to go over this information. If you will notice, what you're looking at is every salesperson tends to be representative of about 100,000 units as far as customer electronics. So it's almost a very even 1 to 100,000 match. When it comes to the industrial components, it's a little different. You notice the numbers do not line up perfectly. In our Eastern Territory, it's a little over 200,000 per salesperson. It's about 2.5 in the Midwest. Now, the Western Territory, it's a 400,000 to 1 ratio. Now, just looking at it, you may not see that immediately, but for some reason, the Western Territories seem to be doing quite well in the Industrial Electronic Components Division. This would let you know either there's something unusual about that territory, maybe the salespeople know something different. That's something to look into. If they're doing something differently, maybe they can teach the representatives or salespeople in the Eastern and Western divisions, or maybe it's just unique to that territory. But it's something to look at and something useful. So, why is all this information important? Well, you're trying to find out, again, what's going on within the company, and we're going to step over into accounting. Haven't had an accounting class. This will be new. If you have, this will be a little bit of a recap. Accounting is a system of collecting information primarily about the cost of a lot of items, where they're going, and I'll let you know whether or not this is good or bad. As you're going on, we have something known as GAAP, or Generally Accepted Accounting Principles. What do we mean by that? Well, you cannot just write up the accounting ledgers any way you want to. Everyone follows the same format, so we all know we're playing by the same rules, and we can make a fair assessment of how one business is doing versus another. Slowly, the U.S. is trying to line up with the International Finance Reporting Standards, which is extremely important when you have a large company that's international and you don't want to do two different sets of books. So in the U.S., it's slowly trying to migrate to the point of using a universal standard of accounting. This is important because you are concerned with things like fraud, people cooking the books. Now, if you have a moment, you might want to look up the Enron company, Enron, on YouTube. One of the really bad examples of people cooking the books for their own benefit. After things like Enron, the federal government decided to get into setting up rules and boundaries, and this is what the Sarbanes-Oxley law is, making sure that people are held accountable. And you see, this is the first time they got around to actually having stiffer penalties, someone possibly going to jail along with the fines, and holding people responsible for the accounting of a company. There are a couple of basic forms of accounting: managerial accounting, which more outside information; financial accounting, which we'll get into; understanding where all the dollars are going, how it's divided up. And this information is generally the first thing you look at when you're looking at a company. We'll get around to the three most popular uses, the three most popular sheets in accounting, or areas, I should say. Now, if you're thinking about getting into accounting, it is a very good field. Always needed. Someone has to keep track of where the money is going, what it's used for, and things of that nature. The highest level, I believe, in accounting is a certified public accountant, or a CPA. You have to pass a very rigorous test, and that simply means that you are extremely proficient at the top of your game. Okay. Now we're going to get into the three most commonly used areas in accounting: cash flow, net income or income statements, and a balance sheet. We'll start there. One of the first things that happen in accounting is a balance sheet. Assets are everything you own. Liabilities are everyone you owe. If there's anything left over, it becomes owner's equity. The basic accounting equation. This is where you start at. What it's really telling you is, if you had a desperate situation and you had to sell everything you own, could you cover all your liabilities? If the answer is yes, then the company's in a pretty good state. If there's anything left over, that is that sweat equity the owner has put into the business. In accounting, you have something known as double entry bookkeeping, which means if you do A on your ledger, it has to be balanced on the other side of the T chart. You do accounting, you remember that. On the ledger, either on your business or someone else's, it has to balance out. If you put $2,000 into the bank's ledgers have to balance that out. They show the deposit of the $2,000, and that means it's a liability to the bank because they have to give you the $2,000 anytime you request it. Where does it also balance out? It balances off on your ledger that the bank keeps. That's just your bank statement. You put $2,000 into the bank, therefore it has to balance off on the other side of the sheet with the bank itself. And this is what it looks like for a household. Everything you own and all the liabilities: cash, money in an account, physical possessions, who you owe. As you can see, this person, Marty, has an auto loan and just the credit cards. Therefore, his owner's equity is a little bit more than $16,000, which means if he had to sell everything he had for some unfortunate reason, he'd still have $16,000 left over. Bump that up to a company, and we're going to use this example of Northeast Art Supplies. As you can see, they have a pretty robust owner's equity, $230,000. Everything they have, and we'll get into a little bit detail on that in a moment. You can just look at the numbers. Everything they own on the left side, on the right side, everyone they owe. If there's a difference between that numbers, this is the sweat equity that the owner has. Let's get into this a little bit. Assets and liabilities, and we're going to start with the asset side. If you'll notice the way that this is set up on that sheet, the most liquid assets are always on the top, things that you convert to cash. Well, cash itself is on top. Current assets that can be converted within a year fall next. Fixed assets would be buildings and things that probably a little harder to get rid of if you had to sell them. Any depreciation or intangible assets, that also includes goodwill, or you have some copyrights to some intellectual property. It's worth something. The name Coca-Cola has intangible asset. It's worth something. Liabilities, who you owe, and the debt you have to pay immediately is on top. The same way that cash is on top on the asset sides. Salaries, taxes, things of that nature. Long-term bills go beneath that. That would be mortgages, car notes, and things like that. Anything left over, and this goes back to the different types of ownerships that we had in another chapter. So proprietorship, partnerships, and things like that. Anything that's not taken out is retained earnings and profitability for the business owners. Okay, income statement. Pretty much how much money is going in and out. Personally, you'll look that this is how much you make after taxes, your expenses, and how much is left over. Just a quick side note, you'll notice this person has a lot of money coming in, normal expenses, and there's money left over, which is a great job. Too many people live paycheck to paycheck. Try to do the I have money left over at the end of the month if possible. Let's do that for a business. Sales. Then everything you have in the normal course of a business. You have to buy inventory. There's normal salaries, rent, utilities, taxes, and so forth and so on. You'll notice they are in the positive. They are in the black. It is a good day. When you have sales, you pay everybody, and there's something left over at the end of the year. Hallelujah. Good day in the park. Move on to our income statement. And for those who are playing along at home, we're on page 453. Revenue. Everything you sell, gross revenue after stuff is paid for. What's left over? Net sales. Now, what are some of those things that you have to take care of to actually get to this point? COGS, or cost of goods sold. Beginning inventory, net purchases, subtract out ending inventory. I need coffee. And there you go. Gross profits after net sales, take out the cost of goods, or the COGS, and that'll tell you after everyone's gotten paid what's left over. When we're looking at that, we have to take care of all the internal expenses, marketing, and just business expenses as they go. Your net income occurs when revenues exceed expenses. Net losses are when expenses exceed revenue, meaning it costs you more to run the business than you're making. At that point, you are looking at, you either make changes in order to increase the revenue, or maybe the business just isn't profitable. Hopefully you can make simple changes and turn it into a profitable business. Okay. Next section is cash flow. And for those who are following along at home, we are on page 456. Cash flow refers to just day-to-day activities mainly. You accumulate them throughout the year, obviously, but just how money goes in and out to collect revenue, paying for things, and what happens along the way. How much is coming in revenue when you make sales, purchase of stuff in order to get the business and keep the business running, and you're paying off your obligations. So what it looks like. Net income after everything is done, taking care of depreciation, new equipment, repair, depreciation of equipment. We're not going to get into that. That would be a little bit long of a detail. That would be an accounting class, just keeping track of the numbers and looking at the examples here. And at the end of the year, how much cash do you have left over? Again, it's in the black. It's positive. It's a good day. Okay, evaluating these statements. And we're on page 458. Well, you have all this lovely information. And just a quick side note, large companies, if you look on their webpage, they will have this usually under the title of investor information. Look in there and you will find annual reports, and all those three charts, those three sections are there. You can compare these between different companies. What we're looking at is a brief history of Microsoft, and those are in billions of dollars, just in case you're wondering. Revenue from 18 to 20, research and development, operational income, sales and marketing. You can see the trends on all of those are going up. As long as the revenue is also going up, it's a good day. Other sections, we talked about financial ratios, just understanding certain things such as turnover and things of that nature. We'll talk about that in a second. How efficient a company is. This is what you're looking for. This is what the calculations are telling you. You're comparing that to last year and other companies in the same field. Certain measurements. Turnover ratio. How long is the goods and or services being kept? You don't want to purchase something in March and not sell it till September. The faster it is manufactured and sold, the more you have money for new purchases, and it's a sign that the company is healthy because you're actually getting the goods and services out the door. Calculating the ratio, what you start with, what you end with, and you divide by 2. This is simply used so you can figure out how fast all of this is coming in or out. Okay, that takes care of this chapter. Hopefully this has been useful for you. Feel free to go back, go over it again if you wanted to study. Hopefully this is something that'll help you with your exams. All right then, thank you. Have a good one. I'll see you next time.